Welcome to Tim Talks Private Equity and Venture, where Tim Cunningham sits down with leading GPs and private markets professionals to explore the dynamic world of private capital. Since 2002, Tim and his team at Touchstone Group have been at the forefront of raising capital for buyout, growth, and venture funds. With decades of hands-on experience working alongside private equity and venture LPs and GPs, Tim brings deep industry insight and expertise to every conversation. Join us for candid discussions with GPs who are shaping private capital today. Now here's Tim.
Hey everybody, today I'm interviewing Will Harborne. Will is a really interesting fella. He sits at the intersection of AI and radical longevity. Will is a three-time founder who helped pioneer high-throughput self-custodial trading before DeFi, decentralized finance, was a mainstream term in crypto. Now he's turned that same appetite for frontier risk to the biology of aging. As a co-founder and GP of LongGame Ventures, Will is backing scientists and founders who want to extend healthy lifespan for humans by not just a few marginal years, but by an order of magnitude that could reshape healthcare and society. His firm invests at the earliest stages in tools, platforms, and therapies that attack aging at its root, from gene and cell therapies to protein engineering and immune system rejuvenation. What makes his perspective unique is the combination of deep exposure to crypto's experiments in incentive design and a conviction that longevity biotech is about to experience a similar phase change in both capital and capability. So in this conversation, expect to hear a candid view on what's real and what's hype in longevity, how to underwrite science-heavy long-duration bets, and whether you're an LP, a founder, or somebody who cares about living longer and better, this is a chance to hear from somebody who's betting the next decade of breakthroughs will literally buy us more time. Hi, Will from London.
Hi, yeah, thanks. Really glad to be here and talking a bit more about LongGame and what's going on in the world of longevity biotech.
So tell us a little bit about how you got here. So there's the entrepreneurial background, the entrepreneurial finance background. You went to, I think, Cambridge, is that right?
Yeah.
I think I saw the information there. So start back in school. Just what did you study? Did that have any influence on where you are now?
Yeah, that's right. So I studied engineering at Cambridge here in the UK, and engineering was something I was very passionate about. Expected probably that I would go and work in kind of more industrial type engineering when I was leaving, but everything I was seeing at the time kept pulling me towards the world of software and startups. In particular, it felt like that's where there was a real like speed and energy that was missing, at least from manufacturing and deeper technologies in engineering in the UK. And so I left Cambridge, went into IBM initially, found that also to be quite slow, and very quickly then transitioned into the world of startups.
Reading the LinkedIn profile, I think you lasted 7 months.
That's right. Yeah. So I'd done an internship there before leaving university, which was great. It was this very elite program, highly selective, but the real job at IBM was quite different, I think, than that program. There were a lot of great people working there, but I mean, ultimately what I was working on was very slow. And so, yeah, I quite quickly left, and I left to join a startup in the crypto world. It was a space that I'd been very interested in all through university, actually. It's kind of very early days of crypto.
What year was this when you went to the startup world?
It was towards the end of 2016 in crypto. So it was still relatively early, but it was starting to get a lot more sort of public awareness. The kind of first big bubble that most people heard about it was kind of 2017. And I joined a company then called Tether, which no one had heard about. It was a very small startup. The CTO was based here in London, which is how I met him. And they were building something called stablecoins, which today is massive and all anyone talks about in crypto. But it was a really eye-opening experience. But really, they operated very differently than other venture-backed startups. They weren't venture-backed actually themselves. It was completely sort of bootstrapped. And it was very clear something different was happening. I mean, it was complete night and day compared to IBM. moving very quickly, doing something very disruptive and controversial in terms of sort of disrupting finance. So I absolutely loved that.
Now, didn't Tether have a moment where the amount of backing for the token came under fire, and whether or not they were, they had been claiming that it was, I think, dollar backed, and they didn't really have the reserves that they said they had. Is that an accurate assessment?
So yeah, there were various events and things. So I think one of the big ones was they were sued by the New York Attorney General for potentially not being backed because they'd made a loan of some of their dollar-backed collateral to a sister company. Essentially, yeah, it was I suppose nobody at the time ever expected that company to be as big as they became, and including
right.
The founders. So they probably at the start were not doing everything exactly gold-plated the way that they would have liked. I think now it's very different. Obviously, it's grown so big that there's a lot of scrutiny.
Well, they were heady times, heady times. We helped Dan Moorhead at Pantera raise their blockchain fund, and ended up at $1.3 billion. Now, it was actually it had a whole series of strategies, including public trading, as well as the venture-backed component of it, and an early-stage token component of it. So I have a passing familiarity with having worked with the Pantera folks, but not a lot more. So after Tether, there were other crypto adventures, right?
Yeah. So I then started my first business in 2019. Which was called RhinoFi. We were venture backed by a lot of the big name crypto venture funds, and also some non-crypto funds like Lightspeed, and basically we started building some infrastructure for other crypto companies. Today, that company is still going and still building, and I think in 2024 was kind of $10 million-ish of revenue. So had a good experience basically as a CEO building up a startup myself. Learned a lot through that process, but decided to step away from that company about 1.5 years ago. And at the time, I was thinking I was going to start another company. But I'd become personally just obsessed with this space of longevity. I'd been angel investing into it. I'd done a lot of other angel investing, also kind of alongside, and just decided once I had more free time and wasn't anymore sort of so focused in on crypto, to just go even deeper, go to a lot of events, met my co-partners on this fund, and eventually, started up. I put in the anchor initial investment, and then we raised a traditional LP GP fund. So it was kind of really an element of just going down that rabbit hole, and really looking at the kind of frontier technologies in biotech. And something that for me was really interesting was a lot of parallels with the early crypto days from 10 years ago of these very, very technical founders who are coming out of research and top universities, but then applying that to this extremely big vision idea of disrupting aging, similar to kind of disrupting finance in the crypto world. And so for me, I've had a very sort of a draw really towards those founders, and then started backing them.
How much of that tendency or desire to move in this direction came from a personal commitment to various sorts of either behaviors or other lifestyle modifications where longevity is the objective? Is that a personal sort of thing as well?
Definitely, that's where I started off. I mean, 3 or 4 years ago, went down that on my own personal health, did all of every test you can imagine, started to moderate my lifestyle, exercise, sleep, diet, and read a huge amount about this, topic, and met lots of the people working in different aspects of longevity. I think I then got radicalized in terms of meeting people in biotech who weren't just sort of talking about what you could do today, but what you will be able to do in the future. And I think the big switch for me when I decided to really focus fully onto longevity space was kind of understanding that it is technically possible to really modulate the underlying process of aging. It's not just we can slightly extend and improve your health in old age, but actually we will be in a position, potentially in our lifetimes, to actually fundamentally moderate this aging process and slow it or eventually even stop it. And that there's no physical reason why we shouldn't be able to do that. And so that for me made it suddenly really exciting to actually go deeper on and to invest into.
And to see that the technology wasn't just ephemeral, that there was some clear evidence that you could proceed in this direction. Well, you mentioned in your materials that this is priced wrong in a way, the market today. What's the core belief? Why is it priced wrong? And how does that influence what you're doing?
Yeah, so I think, looking at biotech broadly, right now valuations are low, and they're low mainly for good reason, which is that historically it's just been very expensive to get drugs to market, first of all, and it's a very long time frame. And then also you just got this big scientific sort of binary risk of you develop a drug, you get some early preclinical data showing it works in maybe a mouse model and helps do whatever you're trying to achieve in mice, and then you develop it through these stages, raise more and more money, and hopefully, if you're lucky, you get good data in humans at some point, and you either get acquired or find other ways of monetizing this. And what's different really when you look at the kind of current wave of longevity startups, which I think is partly an aspect of massive technological change and partly due to the kinds of founders who are really attracted to longevity biotech, is that they are actually moving much faster than you would expect because they're leveraging a lot of the more recent wave of technologies, whether that's in different types of AI computational models, where they're doing a lot more for a lot less money to move much faster, but also using kind of new advanced techniques that have been developed over the last decade in biotech. And then secondly, that actually, if they succeed, because of the targets they're going for, it's not just working on some rare disease with a limited upsize. It's actually the same therapy, molecule, protein, whatever they're developing, could apply systemically to aging and therefore has a market size of eventually everyone on Earth. And so what that looks like typically is that company might be making a molecule that helps to improve the health of your mitochondria. And initially, maybe they will develop it for a specific disease that's related to mitochondrial dysfunction. But because mitochondrial dysfunction is related to aging, everyone on the planet eventually suffers from this problem. And so the same pill, eventually could have a market size of billions of people on the planet who would take it every day with breakfast to keep their mitochondria healthy and slow their rate of aging. And so the upside on these drugs is much, much higher than many other things within the biotech space. And we see them being priced by biotech investors as for that initial indication, but actually having an unspecified, much higher upside.
So you're looking at what you see as a real asymmetry because the ultimate target is everyone, if you will, the human species, as opposed to specific cases of specific maladies where you can charge a huge amount for each therapy and still make money, which always seemed to me to be a strange business model. We've got this great new drug and maybe 5,000 people a year get this very rare disease, but we can charge them a lot of money. That's an exaggeration, of course. But so what's the single biggest non-obvious risk to a longevity-focused fund that LPs might not understand?
So, I think the obvious risk is kind of a scientific risk, and that's where, of course, you have to be really careful. But I think the non-obvious one that we see frequently, and that I think people who aren't investing in longevity often don't think about, is around the go-to-market. So, nowhere in the world is aging actually considered a disease. And so if you actually want to get your drug approved for aging, that's a very difficult, complicated process, which still hasn't really sort of been trailblazed. So you need to basically structure and think about the steps for taking whatever it is that you believe probably does slow aging or help people live longer, healthier lifespans, and initially get it approved for something else, or find some other way to monetize it in order to build up more and more data and eventually figure out how to then get that prescribed to people for aging.
Get it approved for something that already has a, I don't know, ICD-9 or 10 or whatever it is now, and CPT codes and all of that, and then expand it. The GLP inhibitors have obviously had taken that route. I don't think they necessarily intended to, although maybe they did in terms of their strategy. But you do mention that. It seems to me getting the science right used to be harder than it's going to be, and we're on the cusp of doing that better. Getting the people right in terms of actually being able to commercialize, get regulatory approval, and commercialize stuff strikes me as being a real issue. So, what do you think is around this entire thesis is most likely to be wrong, and how do you build avoidance of that error into your strategy design?
The truth is, although we learned a lot more about aging than we did a decade or 2 decades ago, there's still a lot of debate about the theories of aging, about the underlying root causes of aging. Something we're very, careful to do when we think about portfolio construction is not to place all of our bets on any one particular aspect of aging biology. So there are these sort of, it depends who you ask, between 9 to 12 hallmarks of aging, which reference these different aspects of human biology, which get worse as you get older. Some different types of degradation of function, whether that's mitochondria, protein homeostasis, and immune system function, and other things. And we broadly look to kind of diversify across those. And there are companies in each of those sectors working on modulating and improving that aspect of aging biology. And we think it's broadly likely that actually each of the companies in those spaces might claim that that's the only one that matters, and if you can solve that, it'll solve a lot of the other issues. But we think it's broadly likely that all of them are going to play a part, and aging is a complex process.
So the passion of the founders sometimes means you have to diversify your passions so that you can place bets on enough different approaches that it ends up mattering.
Yeah, exactly.
So if a really talented founder came to you with a high probability kind of short holding period oncology asset that had zero longevity component to it, would you do that deal? I mean, if you saw the science, you said, man, this is, wow. Why might you do it, or why might you not do it?
Yeah, we've seen lots of these kind of things, and our typical answer would be we wouldn't do it, and that's because of the type of aging biology. So we'd look at that company and say there are many companies in oncology that we would be interested in, mainly because the way that they're trying to tackle cancer is related to aging biology. So, for example, DNA repair mechanisms, DNA damage prevention, those are very relevant for cancer, but actually have much broader aging benefits, whereas many other type of targets wouldn't. So that's our normal answer. I mean, the truth is, personally, as an investor, I think it's very difficult to stick too rigidly to your rules. And so I think, of course, if there was something where we felt we did have a unique insight and we'd found it very early and it was not directly on thesis, we'd probably consider it. The reasons we wouldn't still, though, even if lots of other things lined up and it seemed like a great founder and a great science, is that personally, I don't think we have edge there. I think there are a lot of great, cancer-focused funds that have specific expertise in, those areas.
Just because you're excited doesn't make it able to be underwritten. Just because you may not have enough nuanced understanding of the sub sector, it's exactly, either it's whatever. It's not your focus. Yeah. Is there one specific class of longevity technology today that you think is sort of overhyped? And then companion question to that is, is there a kind of technology you think is really underfunded, and maybe one you secretly hope never becomes mainstream, even if it works?
Yeah, I think in terms of overhyped, so definitely today the consumer longevity products sort of dressed up as biotech, I think are very hyped up right now. So, that's not true of actually most of the companies we invest in, but things like supplements or diagnostics, which don't have a direct sort of therapeutic pathway, but are more consumer focused. So anything where the kind of moat is more branding rather than biology. And I think that's kind of absorbing a lot of attention and capital right now, but it doesn't really move the aging curve. And so, yeah, that's, and that's sort of not our wheelhouse, but definitely overhyped right now. And I think was the second question, was that more things that are underfunded?
Yeah, underfunded. Yeah, really deserve more capital than they get.
Yeah, I think really it's
which category of longevity technology, I guess?
Infrastructure for drug discovery. So it's seen as a bit less sexy, but things that are compressing the time from discovery to clinic and sort of bringing down the cost, improving the success rate.
Picks and shovels. Some of the picks and shovels type stuff.
Exactly. And you're going to make drug discovery faster, more predictable, even unlock new types of therapeutics. So one of the big things in aging biology especially is that many of the best targets have been known about now for decades. And actually we know some of the genes, some of the pathways in the human body related to aging. We just don't actually have good ways of drugging them. And so if you can unlock some of these new types, and actually some of our investments have been into companies doing that, then you can finally have a way of actually modulating these aging targets and bringing things to market.
Yeah.
So they're not so glamorous, but yeah.
Well, picks and shovels aren't glamorous, but everybody needs them. That's the key, is that it goes horizontally across an entire class of activity. And, that means it doesn't matter kind of who, it matters who wins, up above the infrastructure, but they're still going to need infrastructure, win or lose. So it should have, a lower loss ratio if you do it right. And it's truly transformative kind of infrastructure. So concentration, portfolio concentration. I'm kind of assuming this is a venture strategy where, a handful of outliers are going to be fund makers. But taking that, to an extreme, would you kind of rather have 100x outlier or boring 3 to 10x winners that don't really extend lifespan the way, your fondest dreams have?
I mean, I suppose the number one hope for all of us, not just from a financial perspective, is that one of these, companies does actually, meaningfully solve aging in the sense of allowing people to live beyond 120 years old. And I think if we had one of those in our portfolio, even just one, not just from a returns perspective, that's just going to be, it's opening Pandora's box. Actually, people suddenly see that it's possible to do this, and I think it's also just a home run winner. I think in reality, we are essentially a biotech focused fund, and so while the power law of venture capital still applies, typically in funds like these, it's less extreme than most software funds where you just have this one massive winner, and there's probably a higher rate of exits and acquisitions, but at maybe lower multiples. So I think, and I think that's probably where we're setting our expectation. We're sort of classifying most of our, maybe a third of our portfolio is most likely to be acquired, a third most likely to potentially be those massive moonshot winners and maybe end up IPOing, and a third kind of where it's early enough that they can have sort of both those options.
Well, most biotech funds have rather more limited exit modalities. I mean, you're talking about licensing, because to scale up in any way, it becomes not only CapEx heavy, but, expense SG&A heavy in terms of the budgets to actually get this out and platform properly. So, people license, people sell pieces of, all sorts of ways to try and monetize. Now, the IPO, there are those who do it, but obviously it takes to get to have that kind of a splashy event, which of course doesn't necessarily get you liquidity by any stretch, but it takes a lot of money, and you've got a really small seed stage fund, so you're going to end up maybe not even be able to use your pro rata. You get to those kinds of situations, you just won't have enough money in the fund to participate. So, have you thought of doing anything larger in terms of the next stage of financing? That is sort of a typical path for very early stage VCs, and it may not be as much fun, but it is a typical path. Has that crossed your mind?
Yeah, I think there's kind of a near-term answer to that, which is already now, with likely over the next 2 years, going to be doing some sort of tailored SPVs focused on kind of the Series A's and Series B's of the companies in our portfolio, where we have really high conviction. We've been building a really nice sort of co-investor network who we might then set up these entities and follow in. But yeah, I think longer term, where we want to be positioning is that bigger follow-on fund. It's early for us to, but I think there's already companies that we can now see, the earliest ones we invested in, that are positioning really nicely, and we're going to want to be able to help with those follow-ons and participate in order to capture more of the upside.
What's your reserve approach today? Because follow-ons, obviously, if you're doing an SPV, you can go out and try and find co-investors and all sorts of other stuff. But what do you hold back now for follow-on rounds?
We're only holding back kind of 10%-ish for follow-ons, so very limited in this fund. So most of it will be through these SPVs.
Mm-hmm. So checkbook discipline, one of the hardest things for early stage investors, because you're making a bet that has very little. You just don't know how. What nobody knows what any outcome is going to be of anything. But in a Bayesian sense, it's less certain. And at what point do you stop supporting a scientifically promising company if it's clearly failing to meet its milestones? And how do you have that conversation with founders?
Yeah, I think it's very difficult, I suppose, in our position, because we're not massively doing follow-ons. It's less of a
true. Okay. Yeah. Sorry, man, I'm out of money.
Yeah, but I think there's still that aspect of support in terms of introducing to other investors and just advice. I think my own steer and lesson from my own experience as an entrepreneur is that once you lose momentum, for whatever reason, whether that's running out of money or not having your shot on goal with your drug develop your first attempt in sort of taking your drug to market, whilst there are several options to keep going, and many founders are going to keep going because that's their nature. Things get exponentially harder. It gets harder to attract good talent. It gets harder to attract more follow-on capital, and this even just the narrative becomes harder to sort of sell through every aspect of what you're doing. And so, yeah, I think often just communicating that to the founder gets them to sort of think about it themselves, and maybe think about their options in a less determined way, or at least a less singular way.
So, I think the longevity space, not very ironically, I suppose, but it's these long-dated assets. So you're dealing with multiple years, and yet the usual fund life of 10, 12 years typically ends up adding a couple, 3 more years to try and clean up the last piece of the portfolio. But, by year 14, you're expected to have been out. Everybody's tired. We'll see whether the venture secondary market, continues to grow. It's a difficult one because you have to have some technical competence to be able to understand whether or not something can be done about these assets. But as you look at the fund life, how do you really drive towards an exit if things aren't proceeding apace?
Yeah, I mean, here's, I suppose, the optimistic hope, which is that it does seem as if we're on this kind of inflection point in longevity. There's a lot more funds opening, a lot more capital coming in, both from the family office perspective and in terms of pharma venture arms and things like that. So my expectation probably is that actually in the next, in our fund life cycle, there will be more secondary opportunities. There will be more capital waiting to come in on some of this stuff. That said, when as you said, we can't predict anything. So I think what we try to avoid is companies where there's only one plausible acquisition by a single strategic buyer. Trying to sort of, like, a lot of our portfolio is companies with actually pretty early revenues. A lot of these picks and shovels companies, for example, rather than just pure therapeutics plays where you just need to get acquired or you run out of money. So yeah, it's a little bit of diversification on that sense as well.
Right. If one of your portfolio companies developed a therapy that added, 25 years, 25 healthy years, but carried let's make it a 2 or 3% chance of catastrophic side effects, would you personally be in line to be in the first trial? How do you look at those sorts of things, and who do you get? Because when you're dealing with specific diseases, one of the, I suppose you could call it benefits of that is that you have these patients for whom nothing else is going to work, and so let's give it a shot. But if you've got otherwise people that are normally healthy and aging in a relatively healthy way, and yet there are these potential side effects, and they're very small, but man, the payoff is so asymmetric. How do you feel about that personally, and what do you think that, because that could happen, I think, and then at what point is it no longer attractive? I mean, a 5% chance of catastrophic side effect, 10%? I don't have a good handle on that. What's your take?
Yeah, I think probably, and I think the safety bar is just higher for anything that's longevity focused. Ultimately, if you're taking people who are in general respects healthy and giving them anything, you can't really have even any meaningful percentage of catastrophic side effects. And I think that's just going to rule out things. And honestly, there are therapies you can already go and get today, experimental longevity therapies that you can fly to Honduras and Panama and have today. People do that. People pay hundreds of thousands to have them, and they likely do extend lifespan. It's hard to say how much because they haven't gone through rigorous FDA trials. But the vast majority of people, including myself, are not going to get those therapies because the risks are unknown. There are likely side effects, which again are sort of uncategorized. And so I think if we want these technologies to be mainstream, they will need to go through the typical sort of FDA approval process, and they will need to have extremely well defined and not and safe profiles, which I think they will. And actually, that's the good thing about, again, many of the targets that longevity therapies work on is they are very fundamental to our health. And so if you're improving them, you often actually have side effects in the opposite direction of like lots of other healthy benefits.
Interesting. Yeah. What do you think is a belief about aging or lifespan extension that you think mainstream medicine will call obviously true in 20 years, but it sounds, nutty today?
I think fundamentally the fact which is not just longevity, but the fact even of patients taking control over their health and optimizing it preventatively, proactively is still seems not to be accepted by the mainstream medical community today. I go to my doctor with all my data, and he looks at it and says, this is ridiculous. And anything which it has pointed out, he wants me to get retested through through their own systems, because it's just it doesn't fit within the mold. But I think a natural consequence of this kind of like shift towards longevity and towards people thinking about their own health is that people end up taking full ownership and control of their health and their data, and that then actually empowers them to make better decisions directly. And I think a lot of the other stuff that's being developed within longevity, then people will be opting into, and that's people won't be sick when they're having these things. They will be choosing to have them to live longer, healthier lives. And I think that's a really that's something people will look back at as obvious, but really doesn't seem to be obvious today to most people.
Oh, and this is, I'm 73, right? So I'm a lot closer to the aging, the bad effects of the aging process, and I have. It's been a number of years taking charge of my own health situation, and having moved from Boulder, Colorado, to northern Vermont. I had a physician who in Colorado who wasn't covered by any insurance. It just they don't pay for stuff like this. And she had worked, I guess, 17 or 18 years for Kaiser as a GP, and said, "Look, I'm not doing any damn good." And so she opened up a practice called Root Cause Medicine, and what a journey! And she's a brilliant woman. But in terms of my understanding of stuff and level of interest in it, clearly the N equals 1 in my case is, I ended up with a very young doctor here in Vermont, and just out of medical school, and he's cool with it. But it's his age. His supervisor came in and was not happy with me, simply because I was asking for certain types of diagnostics testing that they don't want to do, and okay, no big deal, I'll pay for it. But I think you're right. I think that there is, and I'm not sure whether it's older people exclusively or not. What is your take on the age distribution of folks who are focused on this at this point?
I think it varies a lot, and there's different, profiles. But I think broadly it is people who are, maybe 50 and onwards, where obviously you can start to think more about these problems. But there's a cultural shift happening, for, just more broadly. I think it's people speaking more about their health, people getting more ability to get diagnostics and to take, and there's basically more tools actually that enable this, and there's a chicken and egg process. It's still shocking though, if you then look at a lot of, and I've spoken to many founders who are building these kind of more consumer focused diagnostics, and actually, although there are, many people who are very engaged with their health and think about this stuff, the vast proportion of the population still doesn't. And even if you, almost even if you told them today that there are these things they could do to improve their health, it's just, not going to happen. So there's a lot of work to just actually engage in distribution. And I think that'll be the second challenge. Even once we have these therapeutics, how do you then get people to take charge of their health and make the most of them for aging?
Yeah, no, in certain areas, I'm much more informed than the average physician. I mean, without exception, and they don't like it if they don't want to have conversations with you necessarily about specifics. In any event, so you've got this founder experience and the crypto experience, and you've got a couple of really strong scientific partners. So, is there a hole in your team right now that you're still trying to fill?
Yeah, there's 3 of us now as partners, and I think that gives a very sort of rounded team. So it's myself as a founder, but also angel investor with a very strong track record. What I really focus on is kind of the picking of founders and teams that we think can have outsized exit potential and who can do something more disruptive. And then Manish, who is the second partner, is really the sort of scientific background. He's been in aging research for the last 15 years, 10 years of that at the Buck Institute, which is in California, kind of the leading aging research institute, doing research in a lot of areas that are very relevant. I mean, we're all aging related, but very relevant for many of our portfolio companies. Some of them notably like.
Yeah, Buck has been a leader for years.
Yeah. And then Sebastian, who is actually a biotech founder and was at the earliest longevity biotech fund as a principal, which is called Apollo Health Ventures. So kind of a very broad coverage then of like what we really need. I think what we, arguably are missing is actually having worked, none of us have worked in the sort of pharmaceutical sort of big league in industry. So when it's thinking about that later stage of how do you actually get drugs to market, how do you deal with the phase 1, phase 2, phase 3 trials, we lean onto a lot of like partners, a lot of later stage funds, but also advisors, and that's something which I definitely would. I'm sure Manish and Sebastian would say they know a hell of a lot about those areas, but none of us have actually experienced and worked in that space.
Yeah, no, good point. Good point. So how do investment decisions get made if there's a disagreement between sort of scientific enthusiasm and commercial skepticism? Maybe there's a recent case of a hard no where the science was just exciting like crazy, but you guys passed. What sort of thing tips the decision?
The truth is that there are that exact scenario you've outlined. There are many cases of. One thing we say a lot is that there are more good scientific, potential therapeutics and other things sitting on the shelf than companies. And so you could have some really compelling data, but no founder, no team that are going to really be able to drive that through, raise the capital needed. It's a long process. It's a process that takes very driven founders. And so, with multiple times we would pass. So we see the scientific side more as just a bar that needs to be cleared. So
that's sort of the minimum.
Yeah, it has to be good science. It has to be compelling data, and it has to have, we have to understand the target and all the things that would mean it's relevant for aging biology. That doesn't mean we're going to invest. That just means it's now something we can evaluate from the holistic perspective of team and founders and how they're going to, and their kind of overall business. And that's what we would then make the decision on in terms of investing. Of course, stronger data, stronger science is great, but that's just the threshold.
Yeah, sine qua non. So how do you avoid the dynamic where, some of the scientists are obviously charismatic. They're driven by the visions that they've got. So how do you avoid the dynamic where a charismatic scientist with a huge vision kind of drives their activities in their team into overly speculative areas as opposed to trying to stay in the middle of the fairway with the project that you guys have funded?
It's an interesting one. I don't think we've encountered that yet in our portfolio. I'm sure it happens because it happens in all areas of startups in general, of losing focus and getting overly excited maybe by new technologies rather than actually the problem you're trying to solve and what you're going to market with. So I suppose, the upside we have here still is that the pure technological scientific piece in any of these is very hard and it's still very new. So I think that naturally stays people to stay quite focused.
What behaviors from a founder would be red flags, even if their science and enthusiasm and other metrics sort of look good? What's a real, we better not get involved with this guy kind of thing?
Yeah, I think the number one is probably cutting corners from a, let's say, data and science point of view. So it's very tempting in this kind of space to dress up, your results, to try to kind of raise more money. You try to move, faster to the next step, and it's how you waste a lot of time and energy of everyone involved, including investors, in biotech especially. We're very. We look for founders that are very frank and honest about the challenges they're currently facing, and understand those and are not delusional and understand how difficult it is to solve, which is something which is usually quite a big differentiator.
Yeah. So when the science is really compelling and the founder is tightly focused on it, what could really go wrong? You have a great founder, you got great science, you got a great commercial. What's the biggest boogeyman that's going to hit more than one portfolio company when you have what looks like a great setup?
Unfortunately, I think it's still fundraising risk actually in this space, which is that there are very few dedicated longevity frontier tech funds. I'd say we're probably one of a handful. So founders have to go and look to generalist funds who typically don't understand the science and what's going on so deeply, or biotech funds that are looking for a very different profile often of company. And so I think that is the thing that we still see as the biggest risk, especially at this early stage for the top founders. They're not fitting exactly into the mold that, other investors want them to fit into. And so that's part of the role I think we're trying to play very much, is to be that signal investor where we've done a lot of that scientific due diligence. We can share that. We can help then more generalist funds to really evaluate these companies. And we do typically see that, which is that, the founders, their vision, the way that they're building their companies resonate a lot with more generalist venture funds. But then they need more help to kind of really evaluate what the kind of biology side of things, and the longevity side of things. So I think that will change. It feels like it is changing, but somehow it's still right now funding is the bottleneck.
Well, if there's such a funding gap, if a founder has other term sheets to look at, and I'm not sure how competitive your space is, but why wouldn't they take money from somebody with more money or a lot of brand equity in their name or something like that? Why would they focus on you guys?
So actually, something we see a lot now is funds want us on their cap table as that longevity signal. So often, at an earlier stage, before or while they're going to then pitch these kind of more generous funds, in order to point at the fact that they have strong science and they have a strong longevity story, and B, in order to then, for example, like we're on the board of several of these companies and giving them actual guidance on how to choose a target that's genuinely related to underlying aging biology or whatever it is. It's really about that sort of proof point of a strong longevity.
So if you come across sort of competitively positioned assets, a combination of founder and science and where they are, how do you maintain discipline on entry valuations where these narratives can sometimes end up commanding a premium? If things are heating up, the popular stuff is likely to be quite popular indeed. Do you just pass, or is there, can you win in some other way? How do you keep your discipline on valuation?
Usually what we tend to do is try to negotiate into the valuation we think is fair with a smaller ticket to sort of be part of that round. Even if the kind of larger investors are maybe coming in later on at a slightly higher valuation. And so we've pushed often for kind of, coming in on a safe at a smaller valuation, having done our DD at a more competitive price. But it's difficult. I mean, it's always the trade-off. I think when you really believe in it, in this company, think it's something special, but ultimately knowing that the valuation at this level, at this early stage, is going to be somewhat irrelevant if they get that massive, if they are that portfolio returner. So it's really a case by case basis. But I don't think there's any perfect answer that we've figured out yet.
Yeah, no, I'm not sure there is an answer, but I think the process and approach is important, and partnering up, regardless of your place in the syndicate, and unless there's virtually no competition for the funding, in which case, your primary idea is to be, fair and appropriate for you and the founder. It's a tough problem, and if you get the funding problem, quote, solved, unquote, then this particular issue is going to rear its ugly head more often because there'll be a lot more money, right? So if a company looks like a financial home run but exacerbates inequality of access to therapies, in other words, it really works, but it's too expensive. Is there a point at which you say no? How do you think about that?
Yeah, I think this is one of our core tenets that we're looking for is, can this be a technology that will scale to everyone on the planet? In terms of that's where I think the biggest value is, but also in terms of that's what is most important. If we want to really make an impact on lifespan across the globe, we need to have these scalable, low-cost technologies. And the good example that was actually in the news earlier this year was a hot mic incident with Putin and Z, where they were discussing after they thought they were off microphone about longevity and about the idea of growing clones, for example, in order to have spare organ replacements for them. Now that's not scalable. Not everyone on the planet could do that. Those two men probably could, and they're probably less worried about various ethical implications. But that's something where I think there is a line. I think what we're actually more focused on is ways to bring down costs. So stem cell therapies, for example, are a good example where there are lots of great technologies out there that have very strong evidence in the longevity space, can have big impact. But right now the cost is just very high. The processes involved in producing stem cells and the supply chain are just unsolved. And so we've made several investments in that space of how do you make these scale better and how do you bring the cost down. So yeah, it's definitely like it's both an ethical and a sort of investment question, but it's an important one.
So are there bright lines within either human enhancement or germline interventions that you personally, and as a firm won't cross regardless of the return potential?
I think it so much comes down to the founders. It's maybe not an easy answer, but like ultimately you have to trust the founders and understand what their value code is. I think someone could be making things on embryo editing or even growing organs in some way for replacement, and as I just mentioned, but with the mindset that they want to make this do this ethically, make it scalable and all the other things, and others could be doing it without that mindset. And so like so much of investing, it comes down to judging the founders, judging the people, understanding their motivations before investing. But I wouldn't say that we would ever rule out any technology just for the technology's sake. And personally, I have the view that any technology that has value to humanity and which could, for example, extend lifespan, probably will eventually find its way into the market and be commercialized. And so it's about stewarding that and making sure it happens under the right people and with the right structures and governance.
Right. So attempt to tilt the scale, if you will, put your finger on the scale towards a better outcome.
Yeah.
Reputational risks. Do you think about this when you're investing? If one of your companies ends up in sort of a high profile ethical controversy, because you're stepping into some pretty deep water here.
Yeah, I think we think about that a lot, and several of the companies in our portfolio, are perceived as controversial, have been written about in MIT Technology Review and others. About, for example, when they touch on various technologies around stem cells, for example, and other things. And so we think about that. I think what we, try to be clear on is our ethical reasons for thinking these technologies are going to be a benefit to humanity are important, and document, our own investment thesis and also document those risks, from a reputational point of view, but also from a moral point of view of like what could happen with these if they're misused, and then try to sort of weigh up what we think is the most likely outcome. I think it's always a difficult thing to quantify that risk, but I think we hope that if we're very clear about our own values and why we invest in these companies, that we at least can defend our position if ever there was a controversy.
Yeah. So in practical terms, how do you differentiate between some bold, non-consensus longevity bet and something that's really kind of reckless, really at heart, ethically or scientifically? How's that balance struck?
I think we would like to think it's based on the science and the founders. So actually, is this real? Is this something that is credible? That the technology and the approach towards developing it is done with a scientific mindset, and therefore can it actually be realized, as opposed to someone just hyping something up and approaching it as in sort of cowboy style. And this is not the kind of space that you can quite approach that way. Unlike some aspects of software development and other technologies, the impacts and the risks here are very serious. And so It's sort of making sure that that's the approach.
Yeah. So you're committing some pretty significant personal capital to the fund. Does it change the way you manage downside risk or upside optionality?
Yeah. So I was the first anchor sort of investor and put in a lot of the initial capital myself. So I think that does always change the way any investor thinks about their fund. I want this to be a fund with fantastic returns. I obviously don't want to lose more of our investments, although I'm sure they won't all be successful as in any fund. But ultimately, I think, the mindset is really about like a strong focus on survival. So, we really need these kind of founders who, for example, like I think we've already do have more of a bias towards well-tested founders who have a second time, third time founders, even when the science is strong, who understand what it takes to actually build a company and that it is a power law game, who have shown before that they can turn this kind of potential energy into kinetic energy. I think, although I always like to, like personally, a lot of gutsy first-time founders, we feel it is like a much bigger risk. And so, there's that slight bias. I think we're very happy to hold scientific risk, as with it being a lot of my own capital, but I wouldn't have I have not much patience for like sloppy structures, bad misaligned incentives, or kind of like, badly run companies. I think so. It's really about sort of tailoring the risks that we have.
So if you had a situation where you were looking at two potential portfolio companies, one just not exceptionally exciting, a lower IRR, lower MOIC, but a higher likelihood of real longevity impact, versus one that had, to be sure, still assessed longevity impact, but a screaming, oh my gosh, this could really take off. If you knew one might had huge, widespread impact, but it wasn't going to return a lot of money, how do you weigh those kinds of situations?
I'm a realist here, which is also, to bear in mind that this is our fund one. We need to get great returns in fund one in order to bring more capital into the space and to support more companies that are working in longevity. If we had a fund one which invested in a whole bunch of companies that are too early stage, doing great research, but got no return, we're not going to bring any more capital and encourage more investors to come into the longevity space. And that's on a big scale, not going to be useful to anyone. So I'd much rather that we get fantastic returns here, prove that the longevity biotech space is extremely investable, and then raise much bigger funds in the future. Maybe we'd put a small check into that company that, it has great, potential impact, but which we don't think is going to be a huge returner.
Right. Dip your toe in as opposed to really committing more capital.
Yeah, indeed.
Well, if people want to find out more about what you're doing, Will, where would they go?
Yeah, our website, longgame.vc, has more information. And we also have a mailing list you can sign up to where we send more about companies in our portfolio. The other big one in January is that we're going to be organizing the first LongGame demo day, where a lot of our longevity portfolio companies will be able to come and present and say more about what they're doing and how they're going to increase all of our lifespans. So
where's that going to be held?
That will be online, but it will be, there's a sign up link which we can share.
So that's on your website as well?
Exactly, yeah.
Very cool. Well, listen, man, I really appreciate it. Learned a lot. I think you guys are doing some pretty exciting things. And I want to thank you for joining me today.
Fantastic. Yeah, it's been really interesting. Thanks a lot.
Thank you for listening. Please visit us online at touchstonegroupllc.com.